Okay, folks, welcome to Best Stock Charts for the new trading week. This is Bob Desmond, and what we're going to talk about today was how was our week last week? How did our 5 top picks for last week perform? From last week's Best Stock Charts, we're going to talk about super micro computer SMCI, and the drama that unfolded with that stock last week was really amazing. And we're going to talk about the stocks that we like for the new trading week. So don't forget to like, subscribe. You know the deal. So what we're going to do is we're going to break this down into the freemium version that's going to be posted on YouTube. And then we're going to have the members version where we go into more of a deeper dive in our trade setups for the new trading week. That's the micro version. The macro version is the whys behind we like the stock. What stocks are they? And the strategy by which we plan on entering the trades. In the members area, I'll be inputting the entry points, stop loss points, and exit points. So members, if you're watching this on the freemium version on YouTube, don't forget to check out the premium version on the website. So let's get to it. Now, last week was just loaded with a chock full of drama. A lot of activity, especially with SMCI, super microcomputer. Now, this was an extreme overbought stock. I saw it around earnings release and how it performed after that, and I purposely stopped looking at it because I knew it was going to go to overbought conditions. And I just didn't know where it was going to peter out. And so finally, I ran a scan. I saw, wow, okay, RSI on MSCI was at 92, so pretty overbought daily time frame. And so what I did is I said, you know what, I don't want to go shorting the common stock yet. Let me just sell a couple of call spreads. So a deep out of the money call, literally well over $100 beyond where the shares were trading. And then simultaneously buy a call above that strike, thus providing us some insurance on the trade. So it was a short position, but it was a defined risk position, and it was also a defined profit, a limited profit potential on the trade. And we still have the trade on. So the shares just kept ripping up higher. I said, I'm missing something here. So I stopped shorting, and I started taking a look at the float. Now, I had learned my lesson with low float stocks many, many years ago, back in 2017 with National Beverage. That's called symbol FIZZ if you want to go back and check out that chart. Low float stock I got into early, and it just ripped my face off, all-time highs, very similar to SMCI. So I said, you know what? Okay, hold off here. No more shorting. Let this thing rip. It's at all-time highs, low float stock. People are in love with the stock. And so what I did is I threw out a hedge. I sold some puts. And then as it got to even more overbought levels, I began selling deeper out of the money call spreads because the option value, and I'll go to it in a moment, the option values was so expensive. The call option values, meaning IV percentile, was at around 78%. Currently, that are 100%. So the options premiums are very, very expensive, very attractive for option sellers like I do. Now, why? Why would they be so expensive? It's because you have so many speculators in there. They can't afford a $700, $800 stock, $1,000 stock. So what do? They buy the call options. Little do they know that it's a trap. And I warned about it in a separate video. I'll link to it at the back of this video. I warned about it. I posted on Stock Twits, Twitter, and I'll link up above here or above here, wherever you see it, where I got some really harsh criticism for my call. This is the night before the crash. And then I knew that there's so many people that were enamored with the stock that, okay, they're so passionate, they're so lost, so not to be rude, but somewhat delusional in the trade that they can't see the risk out there. And as a contrarian, that was the green light that, okay, I had this right. So, I blocked out the guy's name. The purpose here is not to shame anybody or anything like that. It's just to bring light to the way that we could fall in love with the stock and how dangerous that could truly be. And from what I understand, the gentleman that posted that comment, he had to sell out the next day at a big loss. And, I don't want that for anybody. And as a matter of fact, I'll post this other blurb. This is off of Reddit, I believe, and where this gentleman, I had no interaction with him, but I just ran across it, where he lost about $73,000 on a trade. And this is one of the reasons why I post the videos that I do, is that I've been there. I've lost money, blew up accounts. 2000, the stock market bubble back then. I know the feeling. You get what I like to call it is the incredible sinking feeling of losing money and having no control over it. And that is a place where you don't want to be. So, I'll probably do a separate video on the trade of SMCI, but I just wanted to mention it. And I still like the trade, but not as a long, not as a short, but it is an options trade. And I'm going to talk about that as one of my top 5 trades for the new trading week. And in fact, I have more than top 5 trades that I like this week. One of them is going to be a bonus trade for members, because it's really a great setup, and I don't want the options market seeing this, seeing my analysis, and possibly letting the shares get away from me. So I'm going to wait for members. In the premium version, we'll go over that chart, and we're going to go over in detail the trade setups with the options. So I'll show you exactly what these strikes are, the strike expiration dates and whatnot. Let's get to first. Let me share my screen. Let's talk about first, our stocks from last week that we had as best stock charts. And right off the bat is MDY. This is the mid-cap sector. And I had warned members that, I like this sector quite a bit. And I didn't buy in because yields went up higher. And that's not good for the small and mid-caps. I think this is still a great setup. And I still maintain my buy recommendation here, and I may do so myself, but what matters is where are yields going. If they're going up higher, that's a problem for all stocks. I shouldn't say all stocks. Multinational stocks can deal with it. Small, mid-cap stocks are going to have a far greater problem with dealing with rising yields. So MDY I still like, and it was up on the week last week, just shy of 0.75%. It was higher at one point. Now, let's stick with the averages first. The small caps, I own this. I did not go adding more last week. It was up over 2% on the week. This is a leveraged product, unlike MDY, which is not leveraged. So TNA, this is the small cap ETF, and it was up on the week. I'm still long of it. I did not go adding more. Might I? Sure. But again, it goes back to where are yields going? What is going on in the bond market? Because as I always like to say, the bond market is the tail that wags the stock market dog. Don't ever lose sight of that. So I decided to step back away from these. They closed up fine, but I did not trade them. I don't want to take credit for trading them. Another one that we owned and I spoke about last week was LABU. This is a leveraged biotech product, not for the faint of heart. We own it. Did I go adding more? No, but I might this coming week because it did exactly what I wanted it to do last week. It pulled back, did a retest, then a bullish key reversal bar. If you're not familiar with the terminology I'm using, bullish key reversal bar, bearish engulfing and whatnot, there's a link below, 5-part video tutorial, my top 5 favorite candlestick patterns. It's free. Take advantage of it. So I still like LABU here, and I'll probably be adding more, probably doing some selling of put options, which is a bullish trade. Selling the puts is bullish. Buying the puts is bearish. Moving on to Crocs. This is another one I liked last week, and that was up over 10% on the week. Again, I did not trade it. I was too focused last week on SMCI, and really I was obsessed with it, to be honest with you. And again, I'll talk about the logic and the mindset going about that trade on a separate video. I don't want to take up too much time with it. But Crocs had a strong week. I think it's going up higher. I mean, the cup with handle formation, quite strong, much as the saucer with handle formation on the mid caps is still looking good. Nothing really not to like here. The last chart I spoke about last week was fiber. Now, early on in the week, the shares moved up measurably higher, but something happened. I haven't checked in on why they reversed and closed lower on the day. This is what you call a bearish key reversal, meaning we rallied up, closed lower. It's no longer on our watch list. It may come back, but right now I would avoid the stock. I don't like the price action. Perhaps this is just a retest of the breakout point, but I am not enamored, and I'll explain what I mean by that in a moment. I don't know why this just dropped in size here, but okay. Let me blow this up. That's better. Okay, so many times what happens with a stock like Fiverr or whatnot, you'll get a breakout as we did the week prior to last. Then you get a follow through, and then some traders get the Wile E. Coyote moment. And they're like, they got over their skis a little bit too far, too fast, and then your sellers move in because what you have on the stock is a lot of overhead supply. Buyers that bought back here, they got made whole, they want their money back, they're not looking to make a profit any longer, and they sold, and that's okay. And they pulled it back to close right at where the breakout point, where resistance was in prior weeks. Does that mean you go shorting the stock? No, I would watch it. I mean, if it doesn't make a new weekly lower low this week, it could quite possibly be a long. So we're going to keep it on our watch list. No change in our entry point, stop loss point, etc. Again, it's posted in the members area. It's already there from last week. So more to come on Fiverr in the coming weeks, as long as it behaves well. If it breaks down to new weekly lower lows, then we're out. We're not going to waste time here. So that's Fiverr. Now, going into the new trading week, I went over this with members on the week ahead commentary. That is posted in the members area, and that is our strategy session for the new trading week. And I'll give you a glimpse of what my main concern was with the markets, and that was the fact that yields are threatening to break out. The 10-year yield is threatening to break out. And that, to me, is a major concern. If you have bonds that are breaking down, yields that are moving up higher, I don't like that, especially for the small and mid caps, and I particularly don't like it for high-tech beta, and that's been what's leading the market as of late. So what we want to do here is that we want to go to sectors that can thrive in a rising interest rate environment, and that's where my head is at this coming week. So let's get to it. Let's talk about the stocks I like for the new trading week. I'm going to go over the macro reasons why. If you want to join, 14-day free trial offer, cancel at any time. There's a button in the members area, you cancel. And you can get the premium version where I go over the trade in depth of what we plan on doing this trading week. And of course, the entry point, stop loss point, and our price targets as well. So let's get to it and talk about the names that we like. Now, the first chart up, I do not want anyone to think that this stock I'm speaking about as a long because it's investable. It is not investable. We have certain trades we like to do, right? I'm not a big day trader, okay? I don't really do that. It's not my forte. I respect day traders who are really good at it. It's hard. It's hard work. You got to be really quick on your feet. I'm more analytical. So I like to take my nights, my early mornings, I like to go over the charts and strategize. So in the case of CCK, Crown Holdings, first I always look at the macro view, right? This came up in my scanner as an extreme oversold stock. But the thing I must point out here is that while I'm talking about this as an extreme oversold stock, I need to point out the dangers of this stock. It is breaking down and breaking down harshly. We broke down below this lower band of support. This monthly chart is what you call a continuation breakdown pattern. This rally that we've seen since late 2022 is over. That's a bear market rally, and it is done. We have broken down below the lower band of support. A lot of people don't realize that the bear market rally is over, and they're still thinking that, oh, it's going to go to new all-time highs. It's not anytime soon. So what's going to happen here, my prediction is that you're going to get a rally back, right? Probably next month, you're going to get a rally back up and into this $80 per share mark in and around that range. So this is not an investment. It's a short-term swing trade, and I'll go over the why behind it in a moment. Now, the why behind it is that this is a daily chart. We have RSI at 19.71. It was lower. And you can see here that what has happened is that we have a higher low getting put in, and we are forming a potential higher low. We don't know it's going to be a higher low yet. We're just prophesizing that this is going to be a higher low. All right, so here is what we project to be our higher low. Now, this came onto my screen because it's RSI below 20. It's really just making it onto my screen. The only reason why I'm talking about it right now is because we were lower on RSI and now we're putting in higher lows. Volume on Friday was pretty good. Down volume was pretty strong last week. It was above average. I think we're going to put in a double top on ADX red. And I'm looking for a breakout here on CCK. And tight stops here. We'll talk about the tight stop loss orders in a moment when we talk about the trade of CCK. Now, moving on to our next chart. This is L3 Harris Technologies. This is what I like to call a squeeze trade. And what I mean by that is that when you're taking a look at these lines in black, these are your Bollinger Bands. Your Bollinger Bands are trading within the Keltner channels in gray. What this means is that this is a compression zone. There's a lot of consolidation going on in here. Buyers, sellers, back and forth, day after day. And after a while, you reach a critical juncture of who's going to win here, buyers or sellers, bulls or bears. And generally, who wins in a situation like this is where the direction of the trend is, which is up. So I'm bullish on LHX, and I think that we're going to break out higher. So members, stick around. Premium version, we'll talk over the strategy. Now, I have a bunch of banks on here. Frankly, I'm torn a bit. One I like more than the rest. One I would prefer to trade above the other three. So we'll begin with Bank of America. Weekly chart, Bank of America, bullish key reversal bar. Again, one of my top 5 favorite candlestick patterns. Link below, 5-part video tutorial free. Now, what you're looking at here is a stock which is in a clear and defined uptrend. There you go. And what did we do last week? We broke out and we closed just off the highs of the trading week. Now, we love that, especially in light of the fact that you had the markets which traded down, S&P 500 down. And let's do a ratio look at how Bank of America is performing relative to the S&P 500. It's outperforming. Look at this setup, this ratio setup on Bank of America. Here you have it, BAC relative to SPY, S&P 500. And you don't get much more bullish than this. All right, so triangle formation forming. Looks as though the banks are beginning to show relative strength versus the S&P 500. When we see that, and we're wondering, okay, the S&P 500 may be range bound here for a while. How do we find a new bull market within the S&P 500 without having to buy the S&P 500? You do your ratio charts. That's what we do here. And it looks as though the banks are beginning to set up for a nice rally. Now, moving on to Goldman Sachs, which is another one I like quite a bit, because what do we have again is on Goldman Sachs is that we have a setup where we are range bound. We have been in a range for quite a while. Look at how narrow the 2 standard deviation Bollinger Band is in green, and the red, that's a 3rd standard deviation Bollinger Band in red. Very, very tight consolidation. Another view is the way we just looked at Bank of America. And let's take a look at that. We'll bring up the Keltner channels. So here you have it. You have your Bollinger Bands in black, your Keltner channels in gray. When you get your Bollinger Bands trading within the Keltner channels, this all goes back to compression, consolidation, and there's going to be a release of energy very, very soon. And in general, not always, but in general, the probability of an upward move goes in the direction of the trend. What is the trend of Goldman Sachs? It's clear and defined. It is up. So again, members, we're going to talk about this in a little bit greater detail, entry points, exit points, and stop loss points. We're going to be talking about the trade. How do we want to put this trade on? Using a call spread, a long call spread. So we want to buy the options. In fact, I may even sell some puts here. That's a bullish trade again. When I sell the puts, I'm bullish. When I buy the puts, I'm bearish. I'm the banker. I don't want to. I want to be the casino, not the gambler here. So we're bullish on Goldman Sachs, but I do have one other bank I like better than Goldman Sachs, even better than Bank of America. That's the bonus stock. Stick around, join 14-day free trial offer. Members, you'll see it in a moment. Now let's talk a little bit about SMCI. Now SMCI, again, I'll link at the back end of this video the commentary I made the morning of Friday, the day that, what was Friday? The 16th, Friday the 16th. Pre-market, and the shares of SMCI were trading up and around at the peak at $1,080. And I said it was probably going to close below 908 per share. That's my exact number. And we closed out the session at 803.32. And I had pointed out the night before, I put a post on, I'll post an image of it here on Stock Twitch, that I was making the call that SMCI had put at the top. We were done here. It was going to close down below 908 per share, set off a firestorm on the Twitterverse and on a greater extent on Stock Twitch. And sure enough, you had the shares open up. And sure enough, you had the shares open up. They pumped the shares up higher at the open. And I warned that one day that they would pump this stock up higher and the manipulators on Wall Street were no longer going to backstop the trade because they will have now put on a net short position. And the opposite direction was the path of least resistance. It's where the money was going to be made with RSI when we closed out on Thursday night, like 96. That's bizarre. I think it was maybe even 97. Bizarre. So they opened it up, and sure enough, the sellers moved in. No backstop on the part of market participants. They hammered the longs. Now, what do I want to do here? Do I want to buy the stock? No, I do not want to buy the stock. Do I want to short the stock? No, I don't want to short the stock. Then why am I talking about it? Where is the money to be made here if I don't want to buy the stock? I don't want to sell the stock. Options market, pure and simple. And here's the opportunity here, because you're not going to find this often. You're not going to find very often where the call options on a stock are more expensive than the put options. Very rarely happens. It usually happens when there's an overexuberance of bullish optimism in a stock. That's because you have speculators. They'll pay anything to get those options. And it's reflected in what I like to call the IV percentile. Let's take a look. Okay, so here's SMCI. This is a 15-minute chart. We're not really going to talk all too much about the chart because I think that it is kind of in no man's land. I wouldn't be the least bit surprised to see it move up higher. I wouldn't be the least bit surprised to see it move lower. You know, I don't really care which way the stock goes anymore. And yes, I'm still positioned with it with what you call an iron condor. I sold deep out of the money calls. I sold deep out of the money puts. I had booked profits on the trade on another tranche of options. I sold deep out of the money on Friday. And so I'm satisfied. We're a lot smaller in this trade now. But I did initiate a new trade on SMCI, similar to what, as a matter of fact, I'll share it with you. The trade you're looking at right here or here or here, wherever I can find it to place when I edit this video. So that's the trade. It's what you call a strangle, a deep out of, I sold to open a deep out of the money put and a deep out of the money call. Why did I do that? Is it because I am bullish or bearish on the stock? No, I don't care what it does. I'm neutral on the trade. The reason why I sold that strangle is because the options are so expensive. You have an IV percentile here of 100%. Rarely do you see this on a stock that's not coming into earnings, where you have a binary event that's about to happen. Earnings are generally, you know, explosive moves can happen on earnings, so they bid up the options. Speculators bid up the options. Here, you really don't have a big event coming up. It's just the fact that speculators have increased the value of the options so much. First the calls, now the puts, that the IV rank is just too irresistible not to sell premium, because I can get so far away from the closing share price when this IV rank begins to contract and come in as the momentum begins to get lost here on SMCI. It's just printing money on my part. with very little risk and a lot of reward. Plus, you get time decay. So that's the reason why I initiated that trade. And as I begin to see a little bit more stability in the share price, then I'm probably going to add more to the position, and exactly the position that I just showed you a moment ago. I'm just going to keep adding to that trade. And our existing trade, it's an iron condor. I price target about 25% profits on iron condors. So as soon as we hit that mark, I'm going to get out of that trade and perhaps add more to a strangle, whatever we decide to do, assuming that this IV rank or IV percentile is still very expensive. Now, if it becomes cheap, then I'm not going to trade the stock or the options. I'm just going to move on and find another opportunity elsewhere. So that's SMCI and what our plan is for the new trading week. We're still positioned. We booked profits on Friday on one tranche of options. We reestablished with a new tranche with a much more favorable risk-reward profile, far more neutral than where we were on Thursday night. So that's the trade with SMCI. Now, moving on to the stocks that we are focused on for the new trading week. And this is where we go more into strategy in the premium version. And I want to talk about our bonus stock first, and that is the symbol MELI. Why do I like this stock, and why do I think that it's going up a lot higher and probably very, very soon? Let's begin. So weekly chart of MELI.